This workshop's going to be private equity valuation. We're going to kind of go through a bunch of different things and kind of figure out a bunch of stuff. So valuation, most common valuation techniques. Okay, most common valuation techniques, and there are a few. So we're just going to start with something called intrinsic valuation or discounted cash flow analysis. So discounted cash flow analysis, and we could just kind of read off here, and then we'll kind of think about this a little bit. So it relates the value of an asset to its intrinsic characteristics, so its capacity to generate cash flow and the risk in the cash flow. So, and it says here in its most common form, is computed with the discounted cash flow valuation, with the value of an asset being the present value of expected future cash flows of that asset. So what do we know about discounted cash flow analysis? Is there, I mean, does anybody have any thoughts on that, or just kind of what you know about it? Kelly? Discounted cash flow analysis?
When you value the company by looking at the company itself instead of its relative, which is different from the looking at the relative one.
Right.
Not comparing, just looking at the company.
Okay. So she said just looking at the company itself on its own. Joe, you have any thoughts?
I think maybe like the way to work through it is projecting future cash flow, discounting back present, like WACC, discount rate.
Right.
And then that's like the intrinsic value that we talked about. Like that's what we see as like maybe the fair market value of that security.
Right. And it's the present value today. And I'm sorry, what was your name?
Mireille.
What was it?
Mireille.
Mireille? Okay. When you think about discount rates, you think about weighted average cost of capital. What's another way of thinking about that? Does anybody have any other thoughts about it? What is it at the end of the day? Forget about the calculation. Forget about debt and equity and tax rates. What is the reason that you're discounting something? What is the purpose of it? If I had a higher discount rate, does that make the present value higher or lower? My discount rate is 20%. Okay, if I discount to, there you go, Zoom, lower, correct, okay. Zoom people coming in through the clutch. So higher discount rates, lower present value. Lower discount rates, higher present value. Let's think about it like this. When you think about discount rates, think about risk, okay? Higher the discount rate, the more risky those cash flows are. Lower the discount rate, the less risky those cash flows are. So if I took two companies, right? I have company A and company B, and I told you they have the same exact cash flows, right? Same cash flows, but one is riskier and one is not risky at all. Which one would you rather pay more money for? Exactly, right? So less risk, more value, higher risk, right? Now, there's another way of thinking about this. If I want returns, right? I need returns. I'm a private equity investor. I need to achieve certain returns. If I think about a discount rate, again, let's look at it this way. Startup company versus mature company. What would have a higher risk profile? The startup. And why is that?
There's so many unknowns, like no revenue,
right.
sour, everything.
Right. They might not even generate any cash flow, right? So you as an investor, do you want higher or lower returns to invest in that company relative to a more mature business?
Higher returns because taking more risk.
Exactly. So finance, all of finance, investment is about risk and return. And the problem is that this is, the world of finance tries to get broken down in very simple words and simple ways, but it's not simple. And forecasting is very bad. People don't really know how to forecast very well, but you have to have a narrative around a story, right? We can think about publicly traded companies when they every stock, right, is really the present value of the future cash flows, right? There's some earnings in the future that investors are looking for. We can think about companies that generate cash flow and companies that don't generate cash flow. So what you'll see a lot in CNBC, you read a lot in Wall Street Journal, what you'll see on Twitter, people will say, oh, this company is ridiculous because they don't even generate cash flow today, but the valuation is really high. You know, Airbnb is a $100 billion valuation. People say, this is ridiculous, they don't generate cash flow. That's wrong. Why is it wrong? Why do you think that's wrong just to have that simple statement?
I mean, they don't have any assets. They have a website, they have some insurance. I mean, you know, they're using people's homes to hotels in the future. So you're banking on like somebody like us in Montana has a ranch and we ran out of cabinets.
Okay.
They make money just doing nothing and they get a piece of it.
Okay, exactly. But would you ever invest in a company future value expectation, Brian? Okay, and that's kind of getting there. Exactly. At some point in the future, they got to generate cash flow, right? Otherwise, they can't operate as a business. The company itself has to operate in a profitable manner at some point in the future. So if you're able to set up your business in a way where you've invested a lot of capital to ultimately generate a lot of cash flow in the future, this is a valuable business. Okay, it's a viable business. You can get a lot of value for this business. Does this all make sense to everybody? Okay, so yes.
This is probably gonna cover later on, but like I have a friend that works in the financial industry, I had a research. He said that like all the future cash flows are all priced into all these stocks like for the next 5 years. And that's where he said like the big risk is like for a new investor. I'm sure you're gonna cover something like that.
Okay, yeah, we can talk about that.
That's
So this thought process is, I would think of it as an efficient market hypothesis. That's what I would think about. Are you all familiar with that? Anybody familiar with efficient market hypothesis?
And the market is efficient, it's what some market 100%.
Exactly. Like the price today is already taking into account all the future expectations. So I don't believe in efficient market hypothesis at all. I think it's not. Yeah. All right. I think it's bullshit. Are we all adults here? I don't believe it. But look, reality is that University of Chicago. This came out of University of Chicago. There are a lot smarter people than I am that created this. I think it was Eugene Fama. These people are like, they've won prizes and in finance, and why I don't believe it is just because when you work in a private markets, you see that there are no efficiencies. So in the public markets, there's definitely a lot of eyes on stocks. I would think that larger companies are probably more efficient, like Apple, because every single bank on the street covers Apple. There's even these boutique firms that cover Apple, but ultimately, like younger startups, we talk about Airbnb, we talk about Zoom, we talk about these sort of businesses. I think it's very hard to say yes that the future is kind of known by the market. I'm not a believer in that. So anyway, okay, so we got the basics down here, right? Now, talk to me about cash flow. What are some what does cash flow mean? What goes into a cash flow calculation? And I'm going to pick on you for 2 days because I'll tell you what, you walk into a JP Morgan investment banking job and you don't know how to calculate free cash flow, I'm going to be very upset with you. So yeah. So let's think about this now. Okay. So what goes into cash flow? We could just kind of, what do we think about? Yeah. Well, let's start at the top.
cash from operations, like what their primary business is.
Right, but let's even go more basic than that.
Or revenue,
Revenue. Okay.
less costs. You're kind of like walking down almost like an income statement.
Exactly. Okay, so let's start walking down an income statement. So depends whether it's a firm or equity, cash flow, operations, less capex. Good. Okay. Well, let's just think about cash flow of a business, right? What are we generating? We're generating revenue, right? And let's break down a revenue in a very basic format. If I sold computer monitors, so what would be how would the revenue be created? Forget about them selling them, but you have volume, right? Number of units, and then you have price, right? So we think about revenue now, we can think about, hey, we can sell more units at a lower price. We can sell less units at a higher price, right? We can get the same revenue, right? We can sell more units at a higher price. Revenue went up from the year before. We can sell less units at a lower price. Well, this is a problem for us as well. We can sell less units at the same price and our revenue goes down. So we're just starting out revenue. We have cost of goods sold. We have gross profit, right? And we're kind of starting to trickle down our way down the income statement. We have operating expenditures, right? OpEx. This is your overhead, your marketing department, your rent, your employee payroll. And then we can get down to operating income, right? We have depreciation broken in there. So we're going to talk about these things later on. When you get to cash flow at the end of the day, as Brian said, cash flow from operations less CapEx. What is CapEx? Brian, quick, what's an example of CapEx? What was that? That was you? Okay. It's an example of CapEx. Equipment. Okay, equipment. We buy a machine. We make parts. We make metals. We make parts. We need machines to make these things. So an investment in capital expenditures to make these parts and plant and equipment. Exactly. Property, plant, and equipment. PP&E. Now, let's think about that for a second. And we're going to start kind of getting to this point. Cash flow, risk, profile, things like this. Okay. If I told you all else equal, we love using that term in finance, all else equal, high capital intensity versus low capital intensity. I need a lot of money to buy machines. I don't buy any machines. We have Airbnb. We just set up a place, a marketplace for you to rent your home. What company do you think generally, again, all else equal, would have a better risk profile or would be more attractive to investors? A company that has high, now forget about margins, forget about thinking outside of it, just these two facts. I spend a lot more money, I spend a lot less money to kind of get the same revenue. Let's think about it that way. Who would be more valuable? Yes, Brian is like, he's beating you all to the punch on Zoom through chat. So thumbs up to Brian. Yes, capital intensity is very, very important. Why is capital intensity important? Yeah.
Because they can liquidate, they can sell stuff.
It's, well, but
They have assets, they have things.
they have assets, so there's more value in their asset base, but right, it's a use of cash, and that's a great example. Use of cash. I need to spend more to get my earnings, right? For me to have operating income every single year, I got to put more outlay, more cash to kind of get those earnings. So we'll kind of get that conceptually. Okay, excellent. We're going to come back to all this stuff, but I just kind of want to move on to the next thing here. Relative value. We think of it as, we call them trading comps, comparable companies, precedent transactions. This is called relative valuation. People like to use housing as a good example because it's good. It's easy. Everybody understands a house. So if your house is $500,000, and I'm sorry, if your neighbor sells the house for $500,000, and you have the same exact house as your neighbor, your home would likely sell for $500,000, right? Okay. So we all get that concept. It's the same thing with relative valuation. If I told you that a company that generates, 10% revenue growth, and they have 20% operating margins, and they have little capital intensity, trades at a 20 times earnings multiple, and you have the same business with the same profile and the same end customers, and everything is the same, you would likely trade at 20 times earnings, right? This is relative valuation. Relative valuation, it's a funny game because I think of it in a circular way, because it's like there are no two companies that are really distinctly alike, right? But it's easy in shorthand to do it this way. Instead of going into a whole this kind of cash flow analysis, projecting out all the cash flows, if you need to make decisions in a rapid fashion, well, you want to take a look at a few inputs to compare things. So let's just think about this, and people on Zoom can kind of chime in as well. What are some things that you would think I see an eraser real quick, just so I can kind of erase this. This one.
Oh, yeah, we don't have.
There's no eraser? Okay.
Paper.
Okay, that's fine. Yeah, I could just, whiteboard here. They don't come as a student. Just found out. Posting his jobs. Guy's like, man, or like, who's this guy making fun of me? And I'll share this stuff later with y'all. Anything you want. Like I said, I'm very open, transparent, willing to help. So it's important to me. I believe in good karma. So karma is important. Treat people well. Okay. Relative valuation. What would you want to compare about two businesses? If somebody said to you, hey, I want you to compare these two businesses, just give me some things you start to think about. Earnings. Okay. Are there any particular type of earnings? Because earnings can have multiple definitions, right? Well, sales are not earnings in the sense of profit. Okay, let's call it profitability. What are some earnings profitability? Brian said capital structure. Okay, that's important. What is a capital structure? We're going to jump all over the place today. I can see how this is going to go. It's good, though. It's better this way. It's more fun. Capital structure. What does that mean? Debt and equity mix. Okay. I like it. Brian's like he's texting me. He's got like just rapid fire, 2 words. I love it. Okay. Debt and debt and equity. You're shooting me text messages. Don't really text me though. Just kidding. Debt and equity. Okay. I should have Brian come and help teach this class with me because he's helping me move this along very nicely. What does this mean? So, what is debt and equity? What's the debt made up of? How do we think about this? Or I should say this. Why would a company have a lot of debt? And why wouldn't they want to use cash?
Like right now, they all want to have debt because they've lost nothing, so they can make their earnings look better.
Okay, excellent. So I'm sorry, I never got your name.
Aaron.
Aaron? Okay. So Aaron said a company will use debt, right? He said because it's cheap. And when we think about these things, we're thinking about, and Brian's saying tax benefit, and that's true as well. But let's think about debt. If debt is cheap, what are we ultimately looking for? Why is cheap debt important? Because what are we going to do with our debt? So let's think about a transaction. Dean, I invest in debt, right? I'm a debt investor, which is true. That's actually what I do. So I invest in companies. We lend to companies. We give them money, and we make investments. We partner with companies. We also do equity investments as well, but we're doing a lot of debt. We make a debt investment in a company. What do you think that company does with that money? Put it to work, Joe says. So what does that mean? Define put it to work. How could you put it to work?
Whatever debt or whatever you've given them, a loan, they're going to use it for like the normal operations of their business.
Okay, so that would just be called, right. So now we're thinking about terminology. If you're in an interview and somebody says, you want to say general corporate purposes, that's a good statement. General corporate purposes, somebody going to use that for. Now, if they're going to raise money for general corporate purposes, we're going to be a little bit more. So that's a good example. Joe, general corporate purposes. Is that riskier to you or not as risky to you? So if I said I want to borrow $20 million for general corporate purposes, do you think that's a riskier investment or not? Why and why?
Because why do you need money if you are operating as a business and when it comes to the profit? Like
why do you need my debt to pay for your operations? Because what do we technically want them to operate with? their own cash, right? Because this is just you're generating cash flow and you're paying your people and we're just working here. However, when would it be a good thing if we're an investor that we're going to give you debt for general corporate purposes? If what?
Expansion.
Expansion. Because now you're saying, hey, let's go back to the startup conversation we had. A typical startup. Now, when I say startup, there's multiple different phases of a startup, right? There's a startup that reaches just nothing, right? I'm 2 people. There's also rapid growth. Rapid growth would be 20 people. So let's just say this. We're a startup. We have 10 people. Sales. We want our team to go out and sell. You want to raise money from me? This would be general corporate purposes. Why? Because what do you want to do with the sales team now? We only sell, we have 10 salespeople that cover New Jersey. What would we do with the next 10 million if you told me that we want to do this for expansion purposes? Add more people, right? Tiny said add more people. We're going to have 10 more salespeople, right? And where are they going to go? Cover New York. And so on and so forth, right? 10 more salespeople. They're going to cover Pennsylvania. So this is the idea that, and just quickly, can I get this chat to alert me? Is there any like an alert if they send? Because it's silent right now. So. Okay.
Is there a volume up on the keyboard?
Yeah, I'm just looking for it. Okay. No, that's fine. I've been keeping an eye on it. It's just easier for me to keep looking at it. Yeah, I got it here. Okay. So this is kind of when this would occur. Let me just get some more paper for the board here. This is when we're going to be kind of happy to provide capital, right? Capital investment in a firm. Now, risk and return. And I'm going to hammer this all day long because it's so important to understand risk and return. If you don't generate cash flow and you want to raise money, would you raise? So you don't generate cash flow. I'm a credit investor. I invest in debt. I need what? Repayment, right? I need to pay interest. I need to pay amortization. Would I make a debt investment in a company that does not generate cash flow, or an equity investment in a company that doesn't generate cash flow?
Before we do the debt, we have interest rate.
Brian, Robert, equity. That's the right answer. And why equity? Why wouldn't it be debt?
The goal is to get them profitable. So if they show, that they have a good product, something in the pipeline, you want to get them to market so you can get the greatest return on money. And
That is true too, but Brian's kind of got it here with no contractual payments. They can't make them, right? They can't make payments. So I think about this conception, and this is why it's super important. Like I said, more than anything, I need you to take away these concepts. This is the stuff that's the foundation of finance and understanding this stuff. And this is how you're going to be able to kind of walk into an interview and understand and really kind of show your muster. If you don't generate, so how is a term? Let's think about a mortgage. You borrow money, you buy a house. You have to pay your mortgage when? Every what? Every month, okay? You don't have a job, you make no money, right? Can you pay that? Okay, so what am I doing as a debt investor? What am I getting back? Nothing. An equity investment is structured as a partnership, okay? I own part of your company, your equity. No contractual obligation to pay me, right? But I own a piece. And what is the idea now as an equity investor? What am I looking for then as an equity investor? Growth. I think let me just see. I'll go for a 10. All right, Con. Thank you. Appreciate it. Perfect. All right, good. Good luck in your meeting. All right. I'm kind of very happy today that I don't have any meetings. So on our call, I'm always on calls all day long. and I just hop from Zooms to team meetings. It's just like, my day is a lot of talking, and this is really a pleasure for me. I'm very happy to be here. By the way, this is a nice break from my normal life, so I really enjoy this. So equity investment. Equity investment, we're looking for greater returns, right? So when we thought about, this is why I'm bringing this back to our original conversation on discounted cash flow analysis, weighted average cost of capital, cost of equity, risk, return. What are we going to do now? How are we thinking about that? Equity investment is going to be what? Higher or lower returns than debt? Higher, of course. And why though? One word. Risk. Okay? Risk. It's a higher risk on an equity investment. We're going to get into why that is, because it's not just, there's no blanket terms in finance. There's nothing that's just simple to say, oh, because this one thing. People try to do this, and it drives me nuts because it just doesn't help anybody. Nothing is simple and just straightforward. But when you're making an equity investment, you want higher returns. We right now have seeded about 5 different companies over the past few months. We're making $1 million, $2 million, $3 million investments in companies. Structured equity. What does structured equity mean? Some of them may have PIK components to them. What does PIK mean? PIK is an accrual of interest over time, and we can kind of talk about that stuff later. Yeah.
So I'm thinking about it. You said like if you were a debt investor.
What's that?
Like you said, if you're a debt investor, would you rather invest in equity or what's the other part? Or the debt part?
Right.
But wouldn't all that become your risk tolerance? So if you're trying to invest in debt, you can, even though they can make payments, you can get them at a higher interest rate. And if that company dissolves, if the first one didn't pay, equity, that's just out of all the money.
Right. Okay. So she said, why wouldn't you invest in debt at a higher interest rate?
Yeah.
Because if they liquidate, we're the first collateral, ultimately, you're saying.
Yeah.
Okay. So everybody in Zoom land get that as well. I'm not sure, but she's saying, well, why not just invest in debt? Because then if they end up liquidating, you're going to be the first collateralized person in a bankruptcy filing. So let's think about this. Why wouldn't that be a good idea? Why wouldn't it be good to invest in debt in a company that's not generating cash flow, even if we're going to do a higher interest rate? Because if they liquidate, what would be our issue? So let me think about it this way. It's a better way of explaining it. If you invest in a technology company, all right, what are their assets? What's an asset of a technology company? Yeah, just talk. It's good. We don't need to raise our hands. Just talk.
Really like physical. I think it's all like, well, intellectual property or.
Intellectual property is one. Brian, AR. Okay. AR intangibles. That's what I'm really getting at, Brian. But now what's an intangible? What is an intangible of a software company? I mean, I just said the word. Software, right? I mean, software companies have software. So that isn't patents. Absolutely beautiful. Now, Callie said what? Why not just give them debt? Because you're going to be the first now. But let me think about this. The technology company fails. The software company fails because their what's that? Because their software sucks. So now you own their shitty software. Are you happy about that?
No.
Assets are worth nothing in a liquidation. So not all, Brian, but we're going to get to that as well. But that's a good point. But now, okay, this is what I want you to think about. You lent me money, all right? I liquidated. I gave you my software. What are you going to do with my software?
Yeah, it doesn't work now.
What? It's not worth much. So what is that? So you still want to invest in my debt?
No, because now I'm thinking like, oh, this money. But what if your equity owner and that company liquidates?
The point is this. You're getting nothing in both scenarios. If I let you liquidate, you're getting debt, nothing, equity, nothing, right? So why not just invest in the equity? Because your downside is zero in both situations, right? But your upside is so much greater with equity. Don't you think?
Yeah, I guess it all
Right.
comes down to risk tolerance.
Well, of course. Now, look, a debt investor, we do make equity investments in startups, but we don't make debt investments because they don't generate cash flow. So you got to be able to contractually pay a payment. Think about debt. Always think about debt. It's a contractual legal agreement. You and I, we're going to make it, I'm going to give you $1 million. You're going to pay me back 10% a year. This is contractual. If you miss a payment, you default. I can come and take your assets. I can come take your company. So these sort of things are how you have to think about risk, return, and as she said, risk tolerance. Now, you're going to have a certain group of investors that will be interested in your business. Not everyone's going to be interested in your business because a real senior debt shop that does, revolving debt that's asset-backed, heavy asset-backed. Brian mentioned accounts receivable. That sort of fund is not going to invest in your equity because that's not their risk tolerance, as she mentioned. But generally, we're going to kind of think about that way. Now, I'm actually going to skip ahead a little bit because I'm not skip ahead, skip around. So debt. Do we know, and I don't expect anyone to know this, do we know some forms of debt? So do you know some forms of debt for companies, I should say? Companies, what are some forms of debt that companies would receive?
Are we talking about the mezzanine debt?
Which side?
Okay, so Robert, Trainer, Brian's so on point, by the way. Robert, yes, commercial paper, bonds. Brian, revolving line for working capital. Perfect. All right, so let's start there. Revolving line. For working capital. And I would suggest too in Zoom, you should have the chat box open just so you can see everything that we're talking about. So I don't think you're going to be able to see much of me when I'm writing, obviously, on the board. But that's okay. What's working capital? Let me do it this way. I always find if I just give you a better example. If I'm I am Macy's, what's Macy's working capital? Inventory, meaning clothes. Excellent. Exactly, Brian. Inventory. What else would they have now? So that is a asset or a liability? And why is that an asset? Because they're going to generate what from there? Exactly. Okay, so this is a revenue generating, income generating asset, right? Inventory. What is a liability then for Macy's? And who would, okay, accounts payable, Joe said, and then who would they be paying that to? Who's they're payable to then? So I'm buying who do I buy a shirt from? What was that? Exactly, a vendor. And a vendor is Ralph Lauren, right? That's a vendor, right? They sell, Nautica sells in Macy's. The payable is the money we owe them, right? Because a lot of this is done on credit, right? So you're 30 days, 60 days, 90 days. We have a term that we're going to be repaying them. Suppliers, exactly, Robert. So suppliers. So a revolving line for working capital means, what does revolving mean? How do we think about revolving lines of credit?
Keeps turning over.
It keeps turning over, but if I give you a $5 million line of credit, it will be paid in installments, but what's your, so this is good. We call it committed and funded. What do you think these two terms mean? What would a commitment be? So Robert said always open at your discretion, and he's right about that. And Brian said has to be paid down as available, not drawn. Exactly. So Brian, available is committed. Committed dollars, meaning I'm entering a contract with you, and this is available but not drawn. So, to Brian's point, commitment of $5 million is 0 funded day one. And why is that the case? Day one, because you're using it for what? Working capital, right? So let's think about this. I always like to use retail because everybody knows what Bloomingdale's and Macy's, and this is simple ideas. We don't want to talk about technology businesses because what's the point of that? It's just going to confuse us even more. So if I am we'll use Macy's again. When do you think Macy's would draw? So let's think about 12 months. Let me just see here for a second. Okay, great. So let me just pull up. I'm sorry. Let me just do one more thing here. Okay, we can just wipe this down after. I'm sure it's probably more risky that I'm gonna touch that, right? You guys change that every day? Huh? Theoretically, that's not really what happens though, I bet. Probably this mouse probably gonna make me sick. Okay. So let's think about this for a second. Oh, sorry about that. Sorry, everyone in Zoom. I just need to reshare what I'm doing here. And just to point out, if there are things that I'm doing and Zoom is not seeing, please point it out. It's important. You want okay, so Excel skills are super important in finance, by the way. And you're never gonna, know how to use Excel. Investment banking, JP Morgan, two things: PowerPoint, Excel. Love it, learn it, be the best at it. That's all I'm gonna tell you. That's my advice to you. If you want to be an investment banker, PowerPoint, Excel, gotta know. Very, very important. You're gonna live in them, literally. Okay, so we think about a calendar here, an inventory, and revolving lines of credit. Okay, so if I am a retailer, and I just want to pull back up my Zoom chat because I feel like I lost it. Am I out on Zoom? Oh. All right, but where's my chat? Let me just see that for a second. Okay, great. Okay, excellent. So we are a retailer. We have a revolving line of credit. So let's start picking some months here. Let's start thinking about this. When do you think a retailer would start to draw on my line of credit? Right? We see our months. We see January, February. You see all 12 months of the year, right? So let's think about it now. When they start to see? Okay, Brian is beating everyone to the punch here. To buy inventory, i.e., before holidays, October, November, makes all the sense in the world, right? Because what happens during the holidays? Exactly. So what do they need? Inventory. Okay. So they may be zero. There's going to be times around Easter that they're going to probably pull, before holidays, right? Maybe 4th of July or the summertime. They're going to need shorts and T-shirts. So maybe around, let's start, what's that? Memorial Day, exactly. So let's start to say maybe here, they might to draw 5 million. They'll be pretty good for the summer there. What are they going to start doing in the summertime? As long as they had a good summer. So as they start to make money, what are they going to start doing? Repaying, exactly. So let's start to repay. Now we'll do this -1, all right? So now here, let me just, so this is drawn. Okay, so let's say they drew 5 million in April, 5 million in May, and they start to repay one, right? So we get this conceptually right now. Now, what happens? That was my 50-minute timer, but we can just go a little bit longer, and then we'll take a break. Let me just set this for 15 more minutes. Pause. Cancel. Timer. Now, what can start to happen to a retailer? Let's say COVID. It's a good example, okay? COVID hits. Now, forget about it that it hit in March of last year. Let's say it hits in October. This is the first time that COVID hits. That would literally be the worst time for a retailer, right? Because what happened during COVID? They're shut down, right? They can't sell their products. So what do you think starts to happen now to all that inventory? It's just sitting there, right? So now I'm your lender, right? Now let's say you had a $5 million $10 million revolver and you drew it, and now you only have 3 million left, and now it's sitting there. What do you think they start to do to those products as Macy's? What does Macy's start to do? Because they got to offload that, discount them. And what happens when you start to discount? Less profit. You said that? Okay. Profitability declines. Once that starts to happen, this is very negative for the business. Why? Because when did they purchase the inventory? In April, in May, for the summer. But let's, like, as Brian noted, October, November, they bought them at certain prices to sell them at certain prices and to make profit. Now this all declines, right? So this is where the issue starts to roll in, that this is working capital intensive business, right? Because we need inventory. We got to buy inventory. So when you're working capital intensive, remember we were thinking about cash flow, and I'm going to keep coming back to all these terms. So keep hitting them home. Keep hitting them home. Working capital intensive is what, do you think? If I said that you're working capital intensive, is it a positive or a negative on cash? Because let's think about it. They're buying inventory, right? So is it positive or negative to cash? Are we going to be increasing or reducing our cash because we have to buy inventory? Exactly. So if I told you that last year I had $100 million of inventory, and this year I have $200 million of inventory, did I use cash or get cash? Use of cash. So if assets go up, that means it's a use of, and if my assets went down, that's a gain. Exactly. Does this make sense to everybody? Is this important? Very. Because there's cash and accrual, right? We understand accrual accounting? I know you do. Yeah, okay. So accrual is important, and we're gonna think about these things. Now, the interplay between cash and accrual is super important, because let's say you see a company's revenue rising rapidly, but you see inventory is a good example. Let's say that they're booking a lot of revenue, but inventory is shooting up very, very high. What do you think might be happening there? Revenue's going up. The revenue's accrual, right? But our balance sheet is at a point in time, right? So if our inventory is rising, but we're booking a lot of revenue, what could be occurring there? Think about it this way. It starts to get a little bit hairy in the sense that you're going to start questioning these things, right? Why are they booking so much revenue if the assets that generate that revenue are not declining, right? Just general sense here. It doesn't have to be exact. I'm just saying generally, just think about these things conceptually. So this is why the play of a balance sheet, of a cash flow statement, and a income statement are very, very important. Interplay between all of these things. So you make sure you understand them all, not just one. The world is very focused on the P&L, on profit and loss, on the income statement. But that's not just that's not how business is completely played. Business is played in all aspects of the income statement, the balance sheet, and the cash flow statement. Okay. So so we know revolving lines of credit. All right. Well, let's take a 15-minute there.